the consumer space itself. Another company that reported its numbers yesterday was Godrej Consumer, a good set coming in as far as all the parameters are concerned. Earnings beat on the revenue, margin expansion, and the net profit as well. We have Sudhir Sitapati, who's the MD and CEO of the company, joining us to discuss the numbers in detail. Sudhir, thank you for joining in. And firstly, let's talk about the macros itself. How do you assess the macros in the second quarter? Everyone's called it a tough quarter, tough environment, competitive environment as well. That was challenging too. In that, how were you able to do better than the rest? What was it that you did differently?
Thanks, Mangalam. I think the demand situation in quarter two was quite tough. I think there are some structural reasons for which the demand is tough. Also, the postponement of the festivals has affected many categories. I think within that, we had a good quarter in our international businesses. So Indonesia, for example, came to our rescue and did quite well. And within India, a couple of the categories where category development, which is slightly independent of structural growth, those seem to be doing quite well. For air care, for example, for us. So a combination of developing of categories and a combination of outside India markets this time actually doing better than India have been the reasons that we've had a reasonably decent quarter in Q2.
Indeed, decent quarter in Q2. But Sudhir, tell us, what does the second half of the year look like? Early days in festive season, have you seen any kind of pickup in demand?
For us, I would say H2, may roughly be in line with H1. H1, we had about 7% volume growth as a company between the two quarters, which is pretty good in the context of a lot of things. We hope that we can kind of sustain that kind of growth. In the near term, yes. In the near term, October and November this year have, the festivals have all been delayed by a month. So Q3 has some advantage of festivals in it. Which, last year Q2 had a little bit of it.
All right, so H2 looks similar to the 7% volume growth that you did in H1 itself. But let's talk about the margins. There's been a 700 basis points improvement in the gross margins. How much better can they get from here? And how do you expect EBITDA margins to pan out, especially because you're plowing back some of the gross margin savings into ads?
I think we still have a few years of steady EBITDA margin improvement in GCPL for three reasons. One is we expect the EBITDA margins in Indonesia to steadily improve. We expect pretty significant changes in Africa, and we've announced some reorganization of our business in Africa. And as a consequence of that and other things, we expect our margins to improve in Africa. And the erstwhile Raymond consumer care business that we bought, we expect pretty significant margin expansion there as well. So a combination of these three factors will mean that our gross margin and EBITDA margin will continue to go up for some time.
Yeah, all right. Sudhir, could you quantify the volume and margin improvement that you're targeting, which you briefly mentioned?
We are aiming, as our goalpost as a business is to get to high single-digit or double-digit volume growth. We think we are somewhere between 5 and 10 right now, and our aim is to certainly keep every year moving a little closer and closer to what is our goal. I won't say it's our target, but it's our goal, which is 10% volume growth. The margin expansion today, our margin's about 20%. I think we've given between these two, one should expect to see some amount of margin expansion for 2-3 years, moving to, let's say, somewhere 22, 23 kind of margins.
All right, so from 20% you move to 22 to 23% margins in the business. That would mean a decent 200, 300 basis points upside still from current levels. But talking about the international business that came to your rescue in the second quarter, what do you think would be the steady state of Indonesia in terms of revenue and margin? And you did speak about the restructuring in Africa where you're moving to a royalty model. What could the metrics look like out there?
I think in Indonesia, we're quite hopeful. The general macros in Indonesia for the last 2 years have been quite good. So there's a macro tailwind. We're also seeing that one of our key businesses in Indonesia, household insecticide, has started doing very well in the last few quarters. So we're quite hopeful and quite optimistic on Indonesia continuing to do well in the medium term. As far as Africa goes, I think our main job in Africa is to right margin the business. with East Africa and many smaller countries moving to the royalty model, that will mean a contraction in our revenues and expansion in our margins, but ultimately an expansion in EPS.
Okay, all right. Sudhir, what's your full year target for Raymond's acquired business for FY24?
I think we had, when we acquired the brand, we gave out two guidances. One is that in the first full year, we must roughly do the same number that RCCL did in its previous year. Doesn't sound ambitious, but there are two reasons for it. One is that the amount of stock that GCPL distributors sit on is vastly different from what RCCL sat on. So RCCL distributors sat on 75 days of stock. Our distributors sit in GCPL at 10 days of stock. So that's almost 2 months of stock reduction in distributors. So despite that, and we were also reducing a lot of tail SKUs. So despite that, approximately in the first 12 months, we wanted to do what RCCL did in the previous year. We look like we're on track for that. Our second goal is in year 2 to be EPS accretive. So, which is roughly, an imputed EBITDA of 150 crores we should be able to get out of this business. So these are the two kind of things that we want to do from the RCCL business.
All right. So you want to do in FY24 what you did in FY23 in terms of revenue, close to around 620 odd crores, and 150 crores EBITDA in FY25. What kind of FY25 targets that you have on the top line and bottom line for Park Avenue and Kamasutra?
In FY25, we will want a pretty radical improvement in the earnings from RCCL. When we acquired RCCL, the margins were in the late single digits. We want this to go to the 20s in FY25. So that's really how we are looking at this business.
Thanks a lot for that, Sudhir. Appreciate you joining us and looking forward to having a chat with you at the end of this fiscal.